Now let's move forward and look at the next part. The next part is cash concentration. I'll take two examples. One is domestic and the second one will be cross-border. We are first taking a domestic example from India. I have a company called Maruti. I manufacture cars. I have my two plants in Haryana. One of them is at Gurgaon. When I have these two plants at Gurgaon, one in Haryana, I have got across India various sales outlets. And at the sales outlets, I sell my cars and collect the money, which means my collection happens across India, but my spending happens only in Haryana at one location. So what I need to do is whatever money I earn across India has to be brought at the end of the day to one single location so that I can start spending that money. Now if I do not do that, let us look at without that what are my issues. I got an account at Delhi, Kolkata, Mumbai, Chennai and Bangalore and assume that all these are my collection accounts. All collections accounts in most of the corporates are current accounts, and on a current account we do not get any interest. So whatever is the money collected there, I am not able to get any return out of that. That is one. Second point is I as Maruti need to move that money on my own. There is nobody else doing this job for me. So in this situation, since I am not earning any money on the money part at these current accounts and I need to take extra efforts to transfer the money on my own, I engage a bank. I am engaging a bank called Gold Bank. Gold Bank tells me that if you have money at each of these accounts, at the end of the day, I will move that money at one central master account which you designate at any one of these locations. So what we do, in each of these accounts, I got 1000 rupees each. At the end of the day, we will tell Gold Bank that move all this money in Maruti's account at Mumbai, which is the main account or the parent account. So what will happen at the end of the day, whatever is the balance at the end of the day in my sub accounts will move up to my account in Mumbai. All the child accounts now have zero balance and the entire balance is available to me at one single location. And on this balance at one single location, even though it is a current account, Gold Bank will agree to pay an incentive to me based on how much money is parked in this account. And that incentive could be a slab-based incentive, maybe an amount up to 10,000 rupees, so much of incentive. About 10,000 to 25,000, another extra incentive. Below about 25,000, one more slab of incentive. In this way, I am encouraged as your bank's customer to deposit more and more money in this account. So this is the way the cash concentration process would work. In the child account, we'll pass an accounting entry, debiting the child account, crediting the parent account. And in this way, through book transfers, I am moving the money from the child to the parent. Currently, we have done this only within a bank, a single bank, Gold Bank. Now you may also have account with other banks like Platinum, like Diamond. Then in that case, we can also offer this service to you that we will not only move money within Gold Bank, but we will also move the money which belongs to you and is in other banks in that particular country. And in this way, you will now have all your money at one single account in Gold Bank in Mumbai. This is the basic process of cash concentration. Now in all this, whenever you use the blue arrows, we are doing the book transfer. And whenever you are using the red arrows, we are moving the money. And then when I move the money, I may use RTGS, NEFT, chips, TradeWire, whatever to move the money up into the parent account. The second thing is, I can either push it from the child to the parent, or I can pull it from the parent to the from the child to the parent. So this is the main account is known as master account. All the others are sub accounts or child accounts. Now why does Maruti do this? Is because obviously if I get that money in one single place, I'm going to get incentive. And therefore, even if the money is at some other banks like Platinum and Diamond, if they are not offering me any incentive, what it will encourage me to do is deposit money ultimately at the end of the day at one single account at Gold Bank. So one advantage I have is I get the incentive. The second advantage I have is easier cash management. Now I know in totality how much money I have because now I need to look at only one bank statement of my master account telling me how much is the money available. Now I don't need to have my finance managers, finance guys at each of the locations. He can sit at Mumbai and now decide how to use that cash available in Mumbai. And then big ticket deals are possible. Let me explain this concept. Now in many investment situations, there is a minimum amount defined above which only you are allowed to make an investment. Let us imagine that my minimum investment ticket size is 5,000 rupees. I have 5,000 rupees in the earlier example, but it is spread across at 5 different locations, 1,000 at each of the places. Then in that case, if I want to make an investment, I will not be able to do that. But if I pool it at one single location, then I will be able to do that investment. So concentration of cash also helps you in getting that investment done in big ticket deals. These are the advantages which you get at Maruti. Now let's look at the same thing from Gold Bank's perspective. Now from Gold Bank perspective, if you look at it, if we did not offer this process, then the money would still have remained at individual locations, and my advantage in that would have been that if the money remained there in those current accounts, I would not have paid any interest to Maruti. But by offering them this product and by consolidating all the money at the master account, I am actually paying them incentive. So in fact, it looks the other way around, that I am losing money because in the current account, I would not have paid anything, but by taking it to one single parent account, I am paying you interest. So why am I doing this? What is your answer to this question? It looks to be a loss-making proposition. Why should I do it?
Bank has liquidity and they can invest in another instrument.
Shashi Bhushan, from bank's perspective, the bank still has 5,000. Correct? And earlier also, without this scheme, also we had 5,000. So what's my gain?
From those individual accounts, money won't move anywhere. So if the money is moved to the master account, it will continuously move.
So let me ask you this question, Rashmi. When you said that you moved the money to master account in Gold Bank, did you really put that cash in a cash van and it traveled all the way from Bangalore to Mumbai? So what do you mean by money moved? Did you really move money? Did you really move the money? The money remained wherever it is. What you did, that you had a database in which there was one table called Delhi, another table called Mumbai, third table called Chennai, and you simply aggregated the data in all these tables and put it in one single table called Mumbai. That's what you did. So there was no real movement of money for the bank.
Right, but what I want to say, money movement, as in that from the master account, there will be more transactions from the Maruti side.
Why?
For maybe purchasing or for raw data, etc.
Then again the money goes out of my bank. What is my advantage?
Only thing was to bookkeeping entries and all this aspect was.
So why should I do extra headache and also pay the client when without that extra headache I was not paying any incentive to the client? This is my argument.
Liquidity is maintained at my branch, so I don't need to.
Liquidity, Shashi Bhushan, is still maintained at branch, because I just told Rashmi that you are really not taken out the cash out of the branch. You only passed an accounting entry, debiting table A, crediting table B.
So if all the amount goes to master account at the end of the day, so I think that would be the huge amount which they can use for investment.
I'll argue the same once again. When you say the money moved from parent to child to master, have you really moved money? No. You only passed accounting entry where you had table A debited, table B credited. The money remained in the branch. If it was physical money, if you think, did you really put that cash in a cash fund and drive it all the way to Mumbai? The answer is no.
It's giving customer service.
So you can say customer service. So let's understand what is the advantage to Gold Bank. First, have we really moved the money? The answer is no. It remained wherever it is. We only made it appear to you. What I did in bank, to be really frank, is I made all your bank statements of child account 0 and parked the sum of that in your parent account. I only managed your statements. I'm going to charge you for doing that and then telling you I have actually moved money. But for you, it appears to be movement of money. For me, there is no movement of money. It's only moving data from table A to table B. I write a script in the bank that at the end of the day, these are 5 tables. Make everything 0 and the sum of that you put it in one place. How much does it cost you? 0. But at the same time, you are charging me or charging the client for providing this cash concentration service. You are saying that I moved the money for you, pay me my charges. Right? So this is one only. Second, and the second point, that is customer retention. Now I am not offering it as gold and you are offering it as silver. My client is going to go to silver. So I need to retain this client. Silver is not offering it, I am offering it, I will acquire silver's client. This is the second reason. But the most important reason is float and core availability. Let us take another example to understand this. Now all of you maintain an account in the bank. And in the bank, your bank tells you that you should maintain a certain minimum balance. right? Let's imagine that your bank tells you that you must maintain minimum $500 of balance in your checking account. But if the bank has told you that, do you always maintain exactly 500 or much more than that? Much more than that. So let's take that you are maintaining much more than that, and instead of 500 required minimum, you pay or you deposit, let us say, almost $900 as the minimum. Now when you have this, if you look at your bank statements, bank passbook, and look at what was the minimum balance during last 1 year, you will find that instead of $500, it was minimum $900, correct? And below which your balance never went. So when you are giving me this $900, what is the rate at which I am paying you the interest? If you are in India in a saving bank account, I will pay you 4% interest. But what is the behavior of this account? The behavior of this account is like a fixed deposit, because you never withdrew $900. I got that money with me like a fixed deposit, but I am paying you interest on it like a saving bank account. So that itself is one gain. What is my gain? If the FD rate for a 1 year deposit is 8%, I am paying you 4% for an account which behaves like an FD. This is extra benefit, number one. Number two, now I am offering this incentive to you that if you deposit money with me and concentrate it at Mumbai, I will pay you 2% interest. Okay, 2% incentive. Now we are having collection accounts across other different banks. They are not giving you any incentive. What you will now start doing is, don't deposit money in that account or that particular bank. You will deposit, start putting that money in my account now, my bank. So what will happen? Earlier your average deposit was, let us say, $10,000 per day. Now we have started depositing $20,000 in my bank because the other banks are not paying you incentive, but this bank is paying you the incentive. What with this? My core balance, which was earlier 10,000 in your account, has now become 20,000. Now when I get this incremental $10,000, I will lend this not at 2%, maybe at 8%, 9%, 10%, and out of that 8 or 9%, I am paying you 2%. Am I really losing? I am not losing. So what is the advantage I get is my core cash balance is gone increasing, my lending capacity increases along with that, I lend money out of that, and a portion of that is what I am sharing with you. Is my major advantage which I get when I do this cash concentration. Make sense? To other customers. I lend it to other customers, like maybe I take it from Sony and give it to some other customer who needs that loan. Quite clear? So this is why we are doing the domestic cash concentration. Now what is cross-border then? Same process, but across the world. So we saw this domestic. Let's go back across the world. So this is, I've just changed the company and the locations. Instead of Maruti, you have got Ford, and we have got accounts at New York, Paris, Dubai, Mumbai, Tokyo. Whatever is the balance at the end of the day in this account gets parked into one single location at London. So I got USD account in New York, a Euro account in Paris, UAE Dirham account in Dubai, an Indian Rupee account in India, Japanese yens in Tokyo. All of them at the end of the day get converted into either a euro or a sterling pound, and then on this euros at the master account you pay me incentive. This is the other way you can do it in the cross border. So why are we doing this? The advantage to both Ford and Goldman are the same, right? In addition to that, in this example, Ford gets extra advantage. Let's look at that extra advantage which Ford gets. Now all this is possible. In addition to that, Ford can have country and currency risk management, which was not required in or not there in domestic. I am having a currency called maybe Pakistani rupee or some other currency which is volatile. I don't want to have it. Immediately move the money out of that country. Maybe because the country is unstable, maybe because the currency is unstable. That is an extra advantage which you get in doing this. But while you are doing this, there are going to be issues also. Now let's discuss what could be the issues in cross-border cash concentration. Now when you are moving money out from one country to the other country, there may be exchange regulations in many countries prohibiting you from moving the money outside that country. You may lose on account of currency conversion. Many times tax authorities create issues because your interest or incentive may be earned in London in this example, and the other countries say that you are earning money in my country but paying taxes to Her Majesty's Customs and Revenue, the Department of Income Tax in the United Kingdom. In this way, you could have the tax issues or the business issues. There could be also a technical issue. Let's understand the technical issue by looking at this. Now, in this example, we're going to do the cash concentration at London at the end of the day at each of these locations. But your EOD of New York is going to happen after the EOD of London. In that situation, if the parent is to the eastern side of the child, it will become difficult for you to do the EOD cash concentration. So in this way, you have the cash concentration. In cash concentration, then what we are doing is moving the money from the child to the parent at the end of the day. And I could have numerous mechanisms of doing this. One of them is a zero balance. What is zero balance? Is that each child account has zero balance at the end of the day. The second type could be target balance. We tell Goldman that minimum $5,000 must be maintained in the account. If the balance is above $5,000, that surplus gets transferred to the parent. For example, the balance in the child account is $7,000, we'll move $2,000 from the child to the parent. The balance in the child is $3,000, then we'll move $2,000 from the parent to the child. Will exactly maintain what is the balance required in that account. This is called target balance. Then it could be based on entity within a company. Cross group of companies also you can do that. You can do that for single currency, you can do that for multiple currency. And then you could also create pools of pools. You can create one such pool for only Australian dollars in Australia. You can create another pool for sterling pound in UK, another pool for USD across United States, and then you can create a pool of such pools, and on that pool of pools will be paid the incentive. So what is the advantage typically, and when will I use the product is what I will now likely to explain. If I am a corporate, I am collecting money across a country or across the world, and I want to use it at one single location or maybe one or two locations, then I will use the product called cash concentration, and this will involve moving the money up or down from the parent to the child, from child to the parent, within the country, across country, within the same bank, across different banks, and all such payments should move up and down. And in this case, the message types, if I am using SWIFT, I may use an MT103 to push the money, I may use a 104 to pull the money. In this way, my push-pull transactions will happen by using the cash concentration. Now, are we clear on what is cash concentration? Or do you have any questions for me on this?
So when you say we put the money in FD, is it like in our master balance, all of this money they can pull out for any of the transactions?
Yeah, now you have made the money available at one single location, either to Maruti or to Ford. It is now for them to decide what to do.
So my point is, if I am investing in FD, I am putting 50,000 in company.
Okay.
Right? So
who are you?
I am a customer, normal customer, not like expert, normal customer. So in the background, when I say I am open a FD of 50,000, so is it like they can, in the background, they will use that money wherever they require, and they will earn the interest, and then they will pay it to me whenever I ask them?
Of course. I mean, Girish, we don't expect the banks just to take the money, keep it in the back office, and then go on paying interest. From where am I going to pay?
So do they update that the actual amount, actual account, my account, right? So they will debit and credit continuously, or it is like they know that this is a fixed amount?
I got your point. Your point is that suppose I take a deposit of $5,000 from you, and out of that $5,000, I give a loan of $3,000 to Rashmi, another $2,000 to Pankaj. Then your question is, do I pass those entries in your account? The answer is no.
Okay.
Because this is like that novation concept. I owe money to you and they owe money to me independently. Though the actual transaction is I took money from you and gave it to them.
So they will maintain that data separately.
Yeah. So my deposit data is separate. So I'll take another example just to give you the clarity. So many people take a mortgage loan, a home loan. Now imagine that Rashmi takes a home loan for 15 years. In that case, I'm not waiting for a deposit to walk in and give me a deposit of 15 years. Whatever is the deposit available, I'll use it to give a loan to Rashmi. And now if deposit is only for 5 years, Rashmi is going to pay that money back to me after 15 years. I will take another deposit at the end of 5 years to pay your deposit back. So this is called maturity mismatch management. So I'll have to have that maturity mismatch management done. It's a part of what is known as the asset and liability management. Your deposit is my liability, her loan is my asset. So in LM, I'll do this function, have this functionality. Okay, are we clear on what is cash concentration? Yes, sir.
So for the sweeping and pooling,
I have not started on sweeping. We are still on cash concentration. So sorry to interrupt, but I have not discussed pooling. I have not discussed sweep also.
when this pooling happens, right? The pooling,
You are calling this pooling. Then I will use the word real pooling. This is real pooling. If you use the word only pooling, the thought is pooling of information, not pooling of money. So this is real pooling, also known as cash concentration.
Okay. For this cash concentration, right? Once they have an agreement with the customer, say 4, how do the bank pull the money from each and every?
Now go back to that 101 discussion we had, MT 101. You recall that discussion? In which Jumbo authorized Gold Bank that I have got these 10 different accounts, either push the money out of that using 101 or pull the money out of that using 104.
Yeah.
You recall that discussion?
So request for transfer or it's like a deal?
Yeah, so one way it can be done is Jumbo authorizes Gold Bank that use a 101 and push money out of all my child accounts into a parent account. If the child accounts are with different bank. If they are with the same bank, it's a book transfer. There is no external entity involved. But if the accounts are with some other bank, then I as Gold Bank will send out the 101 message to all the other banks where Jumbo has an account, telling those banks that move the money into parent account at this particular location. One way, this is pushed. The other way is to pull. Again, Gold Bank, on behalf of Jumbo Corporation, sends out the 104 to all those banks that I am pulling out the money to this single location. That's why I do it. Are you clear?
And virtual account can be opened with only one bank. I mean, I'm just assuming that. It's not
Virtual account can be opened only with one bank. Whereas this process or product is sold by one bank, but it can be used across banks to pull or push the money out of them to a single location. That's why we added those other banks also. But from other banks also you can take the money in.
I was considering a case where in some country the bank would not be there. So then I can't create a virtual account in that country, right? So in that case I can use another bank who is using that product, right?
Yes. Are we clear up to this point? Now let's move to the notional pooling. The notional pooling means nothing is going to move in reality. Everything is going to move notionally, in our minds only. The concept is same. Now, but there is no movement of money in this. There is going to be only movement of information in this. So let's understand how this will work. Now again, I'm having the example of Maruti having one single plant and multiple locations. And at multiple locations, we collect the money. And what we did earlier, that when we had this $1,000 at each of the locations, we passed accounting entries and moved all the money to one single location called Mumbai. In this case, we are not going to move the money at all. What we are going to do is create a virtual account at the top, which we are going to call as master, and we will pass on only information of how much money is available at each of the child accounts to the main accounts, which means the main account will not have real money. The main account will have only how much money you actually carry in the child account. So money would continue to remain in the child account, and at the end of every day, whatever is the balance available in that child account, the information of that is fed into the real account, main account, and this main account will now show us aggregated notional balance. Money is not there. We know the money is there only in the child account, but what is the total money is available to us by way of information at the parent account. This is the concept. So here we have not moved the money. What we have moved is the information. We are not going to pass any accounting entries at the child accounts. We are only going to pull the information. How much is the EOD balance? Now when you are operating this account, it cannot be operated across multiple banks. It is only one bank. So if you have money at Platinum Bank or Diamond Bank, this information will not be used in this product, because I will pay you incentive only on that money which is parked with my bank. In the earlier example, in cash concentration, I was moving that money in my bank and then paying you incentive. In this case, information about how much money you have elsewhere does not matter to me. So in this case, whatever is the aggregated amount of $5,000 which you see on the screen, on that you will be paid an incentive by Gold Bank. This is if you operate in this way, that aggregate the information, and on the aggregated balance, notional balance, you are paid incentive. This is called as notional pooling. Are we clear here? Okay. Now, when would I use this product, and what would be the advantages of this product, and how do we use the other one, and how do you use this one? So let's start with that comparison. If I was a company who wanted to spend money at one single location but was earning at different locations, then I will use the cash concentration product. I want all my money at one single location. But I am another company. I have 5 plants across India and I need to spend money there only. I don't need to bring it to one single location. Then I will go for this product. So if money is required at the locations only, the child account locations only, we go for notional pooling. If the money is required at single central location, we go for cash concentration. What are the benefits then to the bank and to the corporate? Now the benefits to the corporate are same, excepting you will not be able to get money at one single place. But on the money available within that particular bank, you are still paid the incentive. You still get a single view of how much money is available to you across that particular single bank. These are the advantages which you get. So one advantage is incentive, second advantage is complete 360 degrees view of how much money you have across that particular single bank. Now why would the bank do it? The bank has still the same advantage, because if you're parking money with somebody else, you'll start parking it with my bank, my core balances will increase. And second advantage to me, when we had discussed earlier also, in cash concentration we really never moved the money. What we did is only move that data from table A to table B. Here I am not doing that process, but I am still charging you fees for giving you this consolidated view. These are my advantage. Sorry? The difference in cash concentration, your parent account had real money which you could move out of that account. And the child accounts, if you use the zero balance, child account had zero money at the end of the day. In this, the child accounts will have the real amount, and the parent account will have only information of how much money is there in the child accounts. That is the difference. So we have not moved money from child to parent in this scenario of notional pooling, whereas in the case of cash concentration, we debited past accounting entries, debited the child account and credited the parent account. Here, there will not be any accounting entries. Are we clear? Okay, and we are also clear on the scenarios in which I will use this notional pooling and the other cash concentration. I want the money at single location, I'll use cash concentration. I'm happy with money lying at different locations, I will use notional pooling. Okay. Now the same thing can also be done in cross-border ways. Same concept. But then here you got one more advantage and another disadvantage. What is the disadvantage here? In real cash concentration, you could avoid country risk and you could avoid exchange risk. You cannot do that here, because the money is going to remain wherever it is, in any of those countries, maybe in a volatile currency, maybe in a volatile country. On the other hand, we had one technical issue, that money from New York could not be moved to London in case of real cash concentration. Here we are not moving money, we are moving information. So information can be moved at any point in time. In fact, you don't need to move this information on a day-to-day basis for calculation of incentive. You can move all the information at one go and calculate the month's incentive. So the technical issue that the child is to the western side of parent does not matter. Third advantage here, there is no real movement of money. You are not going to lose anything on account of currency conversion. There is no exchange rate risk involved in this case. There is no exchange regulation applicable in this case. There is no tax issue in this case. These are the advantages, if you want to call them, from the perspective of the corporate. The bank still has the same advantages which we discussed.
But then they can't, they won't be able to spend that money at some place.
At one single location. They'll have to see, that's the logic I said. If you want to spend the money at all the 5 locations, then use this model of notional pooling. If you want to spend the money only from one single location, use the earlier model of cash concentration. So depending upon your need, we will create that product. Disadvantage here? The disadvantage here will be basically that you will not be able to avoid currency risks. You will not be able to avoid country risks. That is the disadvantage. And you will not be able to spend out of one single location. But that choice anyway you have taken because you want to spend it out of different locations.
But then if that money is not really moved in their account, then how bank is earning interest on this?
I'll repeat what we said earlier. In the cash concentration also, did you really move the money? You never moved the money. You only passed an entry debit table, a credit table B. No, so where have you moved the money? You never moved the money.
One basic question, like if I have to relate this to what a retail banking does, like a customer as a, so is that the same combination of link my accounts in one account?
Oh, then hold your question. Okay, hold your question till I come to the next type. And then we have discussed this benefits. Now let's look at the structures and then I'll come to the sweep and the retail product and then we'll discuss them. So now when I have a real parent account, now all the child accounts were virtual. We call this as RAM. You asked each of the customers deposit in the virtual. Ultimately it went to the real. And this information in the child was used only to understand who has paid, who has not paid. So this structure was used mainly for information management. You want to manage your money at one single location. Then you had real accounts at each of those different locations. You create one real account at Mumbai or maybe London. And then at the end of the day, move the money from child to parent. The structure is same. I have changed the classification of the account. Both the types, level 1 is also real, level 2 is also real. We call the same thing as cash concentration. And then we reverse the scenario. Level 1 became virtual and level 2 became real. The same thing gets called notional pouring. So you just change the structure types and then with the same application you are able to provide VAM. With the same application you can do cash concentration. With the same application you can do notional pouring. Just change the classification. So what is my big investment? Nothing. I am doing using the same way. I am showing you different sides of the same coin and calling it VAM, calling it cash concentration, calling it notional pouring. This is how it would work. Are we clear on this aspect? Now these three are corporate products. But what is the product available to both the corporate as well as the retail is a sweep. So let's understand sweep. And those from India will understand what this means, that picture on the screen. What is that? Sorry? Sorry? Those from Delhi. This is for Aam Aadmi. This is a sweep, a jadu, Aam Aadmi. So Aam Aadmi can also have a general, normal person, individual can also have it, and a corporate. But it is called a sweep. You are sweeping money from one place to the other place. Now let's understand sweep on one side and the others on the other side. So let me explain to you how sweep is going to work. Now imagine Rashmi has an account with a bank, ICICI. She has a saving bank account. And usually in a saving bank account she'll get only 4%, 2% interest in India. And when she puts the money there, she wants to earn more interest out of that money. So in that case, she tells the bank that if the balance in my account goes above $500, anything above $500, you sweep it into a fixed deposit account of cluster deposit type. So the balance now has become $700. The surplus $200 is swept by the bank from her saving account into a cluster fixed deposit. If she wants to withdraw the cash, that cluster would be broken, the money would be swept back into her account. So in this way, I am linking her saving account with a fixed deposit account. If I do it this way, I will call that as the investment sweep. She can also do it this way. Let's say you are a corporate, Rashmi is a corporate, and many corporates don't work on Saturdays and Sunday. So now this is Friday evening. And on a Friday evening, I am going home in my company. I have money in my current account. I don't need that money for next 2 days. I am going to need that money once again only on Monday morning. While before going home in the evening on Friday, I tell my bank, sweep all my money in my current account into a liquid mutual fund and sweep it back from the liquid mutual fund into my current account on Monday morning. This is how I can have a corporate related sweep from current account to mutual fund, from mutual fund back into my current account. On the other hand, let's take the third example. Rashmi has an overdraft loan, and on an overdraft, the bank is charging her 10% interest and her saving deposit gives her 4% interest. She again tells the bank, the moment my deposit goes above $500, move $200 from my my saving account into my loan account. And for those days, she will now need to pay less interest. So for interest optimization also, some people may use what is known as the loan sweep. So we have discussed two kinds of sweep, a loan sweep and an investment sweep. Sometimes Rashmi may say 50% of that $200 to loan, 50% of that $200 to deposit. In this way, we'll have a dual sweep. In this way, we can do a sweep. So we have taken two examples, a corporate and a retail example. Even the banks do such kind of sweeps. Let's take an example. Now let's imagine that I am a bank from Australia and I have got a customer called, let us say, Oracle. And Oracle maintains dollar balances, US dollar balances with me in Australia. Now, during the day, let's say this Australian bank works from 9 to 5 in the evening and even Oracle works from 9 to 5 in the evening. At end of the day, at 5 o'clock, Oracle is no longer going to use that money. So what I can do as an Australian bank is, when I have got Oracle's money available with me, at that time, at 5 o'clock in the evening, your Asian markets like Indian or the Middle East markets are still open. And I'm sure we understood what is intraday lending. So intraday, I lend this money maybe in India, maybe in Middle East. By the time the Middle East and the Indian market comes to a close, European markets are open. I use the same money to lend in the European markets. By the time the European markets are coming to close, the American markets are open. By the time the American markets are coming to close, my Australia, New Zealand, Japan market is open. And like this, I'll go on sweeping the money continuously. Next day morning again, at 9 o'clock Australia time, the money is back in Oracle's account. In this way, I'll have overnight sweeps where even the customer is not using the money, customer is sleeping. I use my customer's money to do this overnight sweeps and earn more for that. So it could be banks, it could be corporates, it could be individuals who can use the product like a sweep. Now, do you have any question on the sweep process?
Who is going to take the risk of sweeping the money? Because it is not necessarily every time when I sweep the money, I am going to earn profitability.
Every time you do a sweep, you earn, because you are investing not in stock markets or volatile investments, you are investing in some security which is going to give you a fixed return. Right, so you're, one way we use sweep in Rashmi's case, put it in fixed deposit. Is there a risk involved? There is, but that is there also for saving account, because if you saving a saving deposit or a fixed deposit with the same bank, the risk is that if the bank goes down, she is going to lose both. Correct? So there is a credit risk involved that if you invest, it may not come back. But barring that, there is no price volatility risk. That you invest in an equity share and the price falls. We are not investing in that kind of an instrument. So what we are, I'll use the word, I'm investing in a liquid instrument which is called as a money market instrument. Money market meaning where we invest only in liquid items, like maybe a treasury bill, like maybe a mutual fund for liquidity. Not for, this is not a long-term investment you make. It's only short-term.
So just a question, I mean, in worst case, when we open a fixed deposit, in that case, if worst case bank goes down or something like that happened and bank's money is lost, so those deposits they will still have to pay whenever they.
Who's there?
Bank.
The bank owe you the money, but if the bank has become bankrupt, who's going to pay?
Okay, that's what my question was. So in case they are able to.
So let's talk of two entities. Let's start from, since you are from India, is there any entity in India which tells you that if a bank goes down, we'll pay you your money? If you look at a fixed deposit receipt which you have from an Indian bank, they'll say that your deposit is insured up to 100,000 rupees. There is an entity called DICGC, Deposit Insurance and Credit Guarantee Corporation of India, which guarantees your deposit to the extent of 100,000 rupees. If you go to United States, you'll have an agency called FDIC, Federal Deposit Insurance Corporation. If you put the money in a bank which is insured by FDIC, if that bank goes down, you get an amount of $250,000. You could invest the money in a credit union. There is a entity called National Credit Union Association which assures you that up to $250,000 your deposits are safe. And in all countries will have such deposit insurance schemes available, but then that is not for all types of deposits and that is not unlimited cover of deposits. There will be a certain amount beyond which they will not give you the cover. So if the bank goes under in India, you can get from DICGC 100,000 rupees. If a bank goes under in USA, you could get up to $250,000. So are we clear now on this sweep? Now who had that question on, I said hold your retail question till I come to that point. Pankaj?
Yeah.
Okay. Okay, so let's have a completion of this module. We spoke of this sweep type, and then I told you about one sweep from saving to an overdraft account. That will be one. So this is the sweep. The balance was 10,000 here, on which you would have earned 5% interest. Balance was 25,000, on which you would have paid 15% interest. Balance becomes 14. Surplus 4,000 is transferred. Balance has gone to 10, and the loan balance has come down from $25,000 to $21,000. The advantage of this would be you will be saving interest on this amount of $4,000 to the extent of 15%. This is how your loan sweep would work. You can have investment sweep. Balance is 10 and 20. You get 14. Move that extra, and your deposit becomes 24. And you do both these things simultaneously. This is what we call as the dual sweep. So in this way, you have the interest earning increased in the second example, and in the first part, loan sweep, you are optimizing the interest which you pay to the other side. This is again where the money will move from one place to the other place.
So the overdraft account means a loan or a borrowing.
It's okay. Just to take another example of a similar facility is your credit card. You swipe a card, your limit goes down. You deposit money, it again increases. It's the only difference between an overdraft and a credit card will be you are swiping a card here. Whereas in overdraft, you can write a check using internet banking. That is difference number one. In credit card, usually, not usually, everywhere, for the first cycle, you are not charged any interest. That means if your billing cycle is from first of the month and end of the month, then for the first cycle, there is no interest. The moment you pay back your bill, you don't have to pay interest. Your second cycle starts when you pay minimum dues and roll over the balance. Then that is the second chargeable cycle. Whereas in overdraft, everything is chargeable from day one. That will be the basic. So how you use the account and how you get charged the interest are the two mechanisms, two differences.
So one question, overdraft, if I take a overdraft for a particular day, and by day end if I put it the money back, do they charge them for the time in India?
No. Your interest calculation is done on the balance at the end of the day.
There might be the fee for initiating over.
Yeah, there might be a fee for getting this facility, but the interest calculation happens on the EOD balance, not on the intraday balance. But having said that, some banks have facility of extra limit during the day, less limit at the end of the day. So in that case, for that extra, beyond the end of the day, they may charge interest for during the day. And that goes on the business types actually. Yes, sir.
So before starting this topic, I was in a different cash management. I thought it is a bank to bank, that is a physical currency chest.
Yeah,
This is the kind of transfer it.
Yeah, so we are not on currency chest. Then as we started with Mahesh, we said that we are not talking about banks cash management. We are talking about a corporate cash management where we are going to help the corporate to manage their cash, because this is linked with my payments moving in and out. That currency chest cash management is typically physical cash management. That is your physical liquidity management at different locations through the currency chest.
Cash management comes in the picture, so I thought
No, I made that point clear from the beginning. In bank, there will be two kinds of cash management. One is physical currency cash management through your currency chest concept, and second is electronic cash management. I am having nostro accounts at different locations. I am having settlement accounts at different locations. Those need to be funded continuously to meet my clearing requirements. That will be another kind of cash management.
this is the kind of transfer.
So this could be a transfer. This could be outside, transfer within or transfer outside the bank. Both ways. Yes, ma'am. Which one? This will be done by a bank on behalf of the customer.
So means the relation between the P to B, person to person.
It could be, see, if I'm doing, let's take an example of cash concentration. What you're doing, you're moving money out of my own account into my own account at some different place. So in both the sides it is business. And the same business, the sender of the money and the beneficiary of the money is one and the same. That's how cash concentrations and notional will work. In this example also, the sender of the money, receiver of the money. In case of Rashmi only we said that we moved from Rashmi's saving account to Rashmi's own fixed deposit account. Again, the sender and the receiver is same. So we are helping that entity. Could be an individual like Rashmi, could be a corporate like Sony to manage their cash within the organization. And when I mean by cash, not physical, we are meaning money management.
So there are companies they have application for cash management. So this is this type of.
Yeah, so this is the application feature I was showing you was I am having the same application. I am only changing the classification of account types which are allowed to operate, and then I call that as cash management or something else.
Go to the slide. So in this case, if I have 10,000 in my account, bank is earning 25,000 out of it. It's
No, here you are having 10,000 in your saving account, and in your loan account you are having 25,000. That's what I am saying. So in the saving account, the bank would have paid you 5% interest, and on the loan account you are paying the bank 15% interest. So the purpose of doing this sweep from saving to overdraft is that your balance will fall to 21,000, and on that $4,000 of transfer, you will earn interest. You will save interest. That is the concept here. And in this case, you have got a saving deposit with a balance of $10,000. You are going to earn 5% on that. Your fixed deposit gives you 10%. If you move the surplus $4,000, had you kept this 4,000 in the saving itself, you have earned 5%. By moving that from saving to fixed deposit on this 4, you are earning extra amount of 5%. So in the second example, you are maximizing your earning, and in the first example, you are saving on the interest which you are paying to the bank. That is the objective of this sweep. Are we clear on this point? On the web, are we clear?
Yes.